much as you can. So it's now my great pleasure to invite our next two speakers to the stage. So we're going to have a fireside chat now. A warm welcome to David Hunter, Chairman of the Board of Directors of the Payments Association, and Emma Landrio, who's Vice President of Coin Systems at Onyx by JP Morgan. So welcome to both of you, David and Emma, and I'll hand over to you now. Thank you very much.
Thank you very much. Can you hear me okay? Hi, good afternoon. Welcome to this session. I'm glad to be speaking here today. I want to just introduce myself briefly. My name is David Hunter. I'm a chair of the Board of Directors at the Payments Association. I've been involved with the Payments Association for about 12 years. I have a history of in payments around, especially around e-money. I've been the CEO of 4 e-money institutions, and I'm typically these days acting more as a non-exec director and chair of early stage fintech businesses. So I'm coming at this chat from the payment side of things. Emma.
Perfect. Hi, everybody. Can you guys hear me? Yeah. Okay, great. Thank you for having me. My name is Emma Landrio. As mentioned by Georgina, I'm VP of Product and Solution Design at JP Morgan, specifically sitting in Onyx, which is one of our business units that's focused really on re-architecturing the way that data, money, and assets move across financial institutions. I'm sitting in the Coin Systems subsection where we work with our incumbent digital transfer solution, JPM Coin, as well as focusing on the development of deposit tokens. And since I think the conversation will also go a little bit wider into the industry, I've been in this space for about 5 years now. Prior to that, was a product lead at another big bank based in Canada for blockchain and digital assets, and then was a blockchain for banking consultant before that. So I like to say it's like dog years in blockchain. I've been in this space for quite some time. Happy to be here.
Perfect, thanks Emma. So we're talking about blockchain and distributed ledger technologies, and we see this as obviously a big area of future innovation, and especially how it pertains to payments. So let's touch upon briefly the how it might affect e-commerce. And I'm thinking to differentiate quite quickly between what we know as crypto and what we can think of as blockchain. Crypto in itself obviously has a place and a role to play. For example, the backstory, one of the businesses I was advising for a few years, a company called Coin Payments. Their backstory, the founder was an avid Bitcoin miner, and very successfully. But as you might know, in Bitcoin mining, you need to have the latest equipment, and he wanted to buy the very latest mining tech, but wasn't able to use Bitcoin to buy it. So that gave him the idea that he needed a business that would accept crypto coins in e-commerce. So that's the crypto side, but on the blockchain side, at the DLT side, it's a different piece, and there's lots of different use cases. Have you got some thoughts or ideas about some of the use cases? I have too, by the way.
Yeah, definitely. Well, I think it's important to set the stage, right? To your point, there's kind of two different sides to blockchain. One side being kind of the pure infrastructure play, and then the asset play. So when we think about the infrastructure, the protocol level play, we have private and public blockchains. Private permission networks are where there are various parties who are known by a central network owner who can interact with this distributed ledger. Otherwise, we have public chain that's significantly more open, right? And that's where cryptocurrencies sit at the asset layer, but underlying that is public blockchain. I think when we think about e-com, we can look at kind of the public chain side being able to enable more peer-to-peer payments that are disintermediated, which can bring a lot of efficiencies into the process. But when we think about kind of, and I guess coming from JPM, we're a corporate and investment bank, we think a lot also about how private chain and on-chain settlement systems, what kind of impact they might have on e-commerce payments. And I think mainly we're looking at more efficient and more disintermediated cross-border payments as well as domestic e-commerce payments, where because we are able to use a source of truth to settle faster in between these parties, we might reduce reliance on things like credit provision that play a big part in cross-border payments or in e-com payments today, and are able to just have more quick access to your liquidity and better liquidity management, so less capital locked in flight by using these kind of efficiency-driven tech. I think that's purely the payment space.
Yeah.
The other piece that I would be remiss not to mention, of course, is logistics, right? By using a transparency-driven network where we can track the provenance of our goods and the movement of goods throughout a supply chain from really the end-to-end value chain, we can have really, really strong proof of provenance for various goods that we're selling, as well as more verifiable proof of just what types of primary instruments or primary materials went into these goods, where they were sold, if they're resold.
Ethical sourcing.
Exactly.
Yeah, and I think that's a really good point. And of course, we do dwell on the payment side of e-commerce quite heavily, but there are so many use cases for blockchain and DLT across e-commerce, as you say, sort of checking supply chains, provenance, logistics, fraud prevention is a huge area, identity and verification, of course, and just efficiencies across the various operational elements of e-commerce. But let's focus on the payment side. The big thing we're seeing at the moment is the emergence of digitally native money. I think of 4 flavors really, 3. Let's say 4 if we include crypto. Crypto, in a way, is more of a digital asset in a way, rather. But so the 3 that come to mind are stable coins, which are starting to emerge. Think of fintechs as bringing stable coins to the market very quickly. Deposit tokens, which I know you're going to talk about very heavily shortly, and CBDCs, central bank digital currencies, which are, is on the agenda of most central banks around the world right now. Some obviously have started to implement quite heavily, like China. Others are still at the drawing board, and some of them are scratching their heads around what the regulations might mean, what the issues might be. So, can you give us a little bit of an explanation about those, and where perhaps the one that some of the audience might not be too familiar around the deposit tokens, what they are and how they fit?
Definitely. So I think, first it's important to set the stage that the growth of the need for these kind of on-chain digital forms of money have really been perpetuated by the growth of tokenization. I'm sure we've all heard about all sorts of tokenization happening over the last years, particularly in the security space, DVP, PVP, where we are issuing, real world assets or real world securities, proofs of them onto these blockchain environments so that we can trade more atomically, fractionalize these assets. There's many, many different benefits to why you might want to tokenize an asset. But what's really happened with that is that we've then had kind of the asset arm that's been digitally transformed, but we haven't really had the payment arm be digitally transformed. So we need forms of native digital cash-like instruments to really play at that payment layer. And stablecoins right now have definitely taken that role. The reason being that, they're somewhat a stable form of digital money and they exist, but they've largely struggled to maintain their value. I'm sure I don't need to walk through the whole last year and the many, many issues we've seen with stablecoins crashing. But the other piece of it is not just maintaining value from a global financial point of view. It's also maintaining the singleness of money, right? Maintaining our one domestic means of payment that helps us really maintain strong monetary stability in a domestic market. And so from that, we've started to see central bank digital currencies, which for those of you who don't know are essentially a digital representation of central bank money. We've started to see wholesale central bank digital currencies come to prevalence as a means of settlement. But the truth is they don't really exist yet, right? To your point, there are some retail central bank digital currencies. There's been pilots, but they can't widely be used for the settlement arm. So we've seen an opportunity to bring commercial bank money into this picture for these different settlement functions. We're viewing this as deposit tokens, importantly, not tokenized deposits. The idea being that we are looking to create a blockchain native demand deposit that can be used in these on-chain environments and issued into different environments. They really represent a digital proof of a demand deposit claim against the issuing institution for a fixed fiat amount. But importantly, that demand deposit belongs to whoever that token holder is. And from our point of view, we see it as a couple key features, one being a fixed liability. This is how we're getting around a lot of the contagion and instability issues that stablecoins have had. So it's always a fixed amount, and it's not linked to a basket of reserves or currency fluctuation. It's whatever that fixed amount that the user would have originally deposited. We also see, and I think this will lead nicely into one of the points that you touched earlier, is that we are looking at developing out deposit tokens on EVM compatible chains because we believe that we need to create a new contract standard that has more features that are required to play and use these tokens in traditional financial environments, one being digital identity and transaction controls, right? We can't be, just looking at wallet addresses and servicing clients with only that level of information. We have sanction screening, transaction monitoring, and AML considerations.
So we're seeing these three types of digitally native money emerge. As we say, stablecoins seem to be getting fastest to market, but have some real concerns. I think the regulators are trying to catch up on that. Certainly the UK regulator sees stablecoins as essentially as a form of e-money, which requires deep safeguarding of funds, etc. So you can't have a run on those funds. We see, the central banks looking at their digital currency opportunities, and we see that they're really struggling with the challenges. What does it mean? What might it do? One of the challenges is that it might create competition for deposits, and therefore, hamper commercial banks' ability to lend if they have fewer deposits to do so. Is that why commercial banks are starting to address these challenges with such things as deposit tokens, do you think?
I think deposit tokens really has come out of a need for innovation right now for the cash arm. And then secondly, there are, commercial bank money is the type of money that is the largest in circulation, 10 times more than central bank money. So there's actually just a lot of use cases where we need a cash-like instrument to use that represents commercial bank money rather than just central bank money. Because if you're only using central bank money, you're always going through your end-of-day settlement flows. You're always relying kind of on the messaging flow as one and the clearing flow and then settlement as another, and interacting where there are only existing structures, whereas we saw, or not just we, but I think as an industry and regulators all see the importance of being able to test settlement with commercial bank money and have something that is available in the near term while CBDC is not, without necessarily saying that, deposit tokens are not going to take away from the systemically important flows of central bank money. We see them working together when CBDC comes in, as well as when deposit tokens are largely available by different institutions. And importantly, they'll always be strong on and off ramps that then fit back into end-of-day settlement with central bank money so that we can maintain some sort of vision on money supply and singleness of money. But to your question about the regulators, they see this importance because if you look at things like the DLT pilot regime, which is ran by the EU Gov, if we look at FCA Sandbox, some of these different supervisory sandboxes where we can be, testing these different types of on-chain trading flows, commercial bank money has largely been made an option to actually try this settlement in under the supervision of these advisors.
I would agree, and I sense there's a bit of backpedaling by the Bank of England on CBDC, for example. There's definitely a political will in the UK, but at the regulatory level, there seems to be some resistance, understandably so. What I'm seeing is that first of all, to reiterate your point, they're seeing many more use cases at the wholesale institutional layer rather than at the retail layer potentially. And also they see what they're trying to do with the next generation of RTGS essentially being, rather than a central bank digital currency, they're looking at a central bank digital clearing system. That's where I feel the energy is going with the Bank of England. Would you say you see that as well, or?
Yeah, I mean, I think there's been quite a few different pilots for a wholesale CBDC, some of which definitely are focused with, RTGS modernization or in the EU Target 2 modernization. And I think they're really important because a lot of those use cases settle in central bank money today and are, can't necessarily go into a more bearer or token-based format because maintaining kind of the separation of the actual token structure or the financial structure and then the messaging piece is incredibly important to reporting and financial stability. Yeah. So we've seen a lot of different potential ways of looking at it, other ways where there's different CBDCs that work with various deposit tokens and are used interchangeably. So I think it's going to be very interesting to see how it progresses, and I hope that by working with the different regulators and the many firms who work with those regulators, we'll start to see even more diversification in the solutions so that we can understand what types of CBDC designs are going to be prominent in the future.
Yeah, makes sense. I'm just conscious we only have 15 minutes for this session. We're slightly over, but are there any questions on this vast subject of digital native money, stable coins, CBDCs, and deposit tokens?
Quick question. I actually a customer of JP Morgan. I have a couple of credit cards, and every time I do the transaction, I actually get a cash back, 3% roughly. And I also own some cryptocurrency, and I pay sometimes with that. And every time I pay with the cryptocurrency, I normally pay roughly 10% more on my purchase. That's how this fee structure works right now. So what's your forecast? We will get closer to the credit card transaction fees, and when, and what will support it? How does it work?
Yeah, I mean, I think for deposit tokens specifically, or for digital currency in general? In general. It's hard to say, really. I don't think we have a full vision on what that's going to look like in the future. Of course, there's going to be various business models that emerge, but it really depends on the type of currency that we're looking at. Because I think if we're looking at stablecoin, if it's an EVM compatible stablecoin, there's always going to be gas fees. There's always going to be high transaction costs, which ultimately lead to higher cost for those transactions, as you well know. And with central bank digital currency, I think that generally from a larger industry point of view, there's probably not going to be significant cost in the same way that there's not significant cost if I want to hold a 10-pound note, unless it's, an ATM or holding large amounts of collateral. So I think that this is just an opinion and speculation really based on what I know from the industry, but I think that could be somewhat replicated with central bank digital currencies. And then I think for, deposit tokens with various banks, it will again be up to what those use cases are, what the utilities are, and how they're structured. But I think really interestingly on kind of the financial point, and maybe not on the costing, but actually on some of the benefits, that stablecoins in comparison to deposit tokens are that, deposit tokens, as we develop out new smart contract standards, we can be developing out standards so that they're interest bearing, so that there's actually a benefit to be holding deposit tokens, whereas stablecoins don't necessarily have that. So this is so new that I don't have a great answer for you of what it's going to look like. I'm not in the art of prediction.
Just on that specific question, yeah. I mean, I'm thinking that inherently the technology side of processing a crypto transaction is very, very low. Okay, the low cost typically, but of course there are risks associated with that. There's also cost in the clearing into a fiat currency. Those exchange rates on and off ramp are not particularly attractive. And there's also the risk of currency fluctuation. So I suspect those are the things that are being costed in rather than the actual technology transaction fee element. Any other questions? Or do we have time for any other questions? No, we don't. Okay. So if you do have any other questions for us, please find us later on in the hall. Thank you very much, everybody.
Thank you.
Thank you, Emma.
Thank you.